financial position and statement of profit or loss. That are the two things that I have to prepare. Okay, and then before I can actually draft out the skeleton here, all right, this is actually the skeleton and I have already drafted out for everyone, so you just need to tick in accordingly. All right, let me just enlarge also. Okay, so the first thing, before I draft out this whole skeleton, I want to know what is their relationship first. So on 1st April 2018, Apple Berhad acquired 80% of Orange Sdn Berhad. So here, this is the first key point that I want to know. Okay, so which means Orange is a subsidiary to Apple. Okay, I can move on already. The second one, Apple Berhad also acquired 100% of Banana Sdn Berhad. So basically, Apple Berhad currently have two subsidiaries, Orange Sdn Berhad and Banana Sdn Berhad. All right, that is more than enough for me to prepare my skeleton already. So this is basically my skeletons that I have already prepared for everyone. Okay, please download if you have not do so. I have just uploaded it only. As you can see, it's here. You can download. Okay, once you have downloaded, then we will do together. Have everyone downloaded this worksheet? Can you raise your hand if you have downloaded this? No raise hand, haven't downloaded. Oh, everyone raised hand already, yeah? Okay, so downloaded, all right, good. So downloaded, then we will move on, okay. So as you can see from my worksheet here, that is how I always prepare my skeleton. Some of you might ask me, can I prepare like, let's say just a single line item to show console, and then after that I have my adjustments here? No problem, okay? The only thing that I like to use this method is because now it's online, considered as online assessment. So this is considered as a benefit for me. When I know how to utilize Excel, all right, and I know how to utilize the formula, basically it is much more easier for me to allocate my time accordingly on consolidated question. All right, so here, as you can see, for console part, I only take in some B, C, D, and E. Sorry, 30 seconds. Okay. All right, I move on. Okay, sorry. So as you can see here, I just take in a very simple formula only, which is a sum of B, C, D, and E. Okay, so why is it B, C, D, and E? Because for consolidation, I have already mentioned to everyone, regardless whether how many shares or how many percentage of shares that this parent company is owing, is earning, okay, or is owning, basically, you only need to amalgamate the financial statements. Amalgamate means you combine the financial statements. So Apple, Orange, Banana, and consolidation adjustments, you just need to combine as a whole. All right, even though for this question, Apple only acquired 80% of Orange Sdn Berhad. Okay, but you don't have to take in like 80% of Orange, 80% of Banana, no need. Okay, you just take in as a whole, and you can see that all the numbers here I just obtained from the summarized statement of financial position, and it is very simple only. So you can see the figures are all the same. Okay, and for the very first step, most of the time I like to have a checking, okay, a sanity check, in order to ensure that my total equity and liabilities are equivalent to my total assets. Okay, I don't care about the adjustments first. I just do a sanity check, so at least I know. All right, and for my statement of profit or loss, it is also the same thing. Okay, so I don't care about what are the adjustments first. I just take in and I amalgamate first. For my consolidated statement of profit or loss, I am also amalgamating Apple, Orange, and Banana. So it is a very simple one, a very simple worksheet only. Okay, so now let's move on. I have already prepared the skeleton here. Let's move on to the additional information. Apple Berhad's policy is to value the non-controlling interest at fair value at the date of acquisition. So the fair value of non-controlling interest in Orange Sdn Bhd on 1st April 2018 was estimated at 13 million. Okay, so it was estimated at 30 million. So as I have mentioned to everyone, the very first thing that you have to do is your first step, your non-controlling interest at acquisition. Okay, so here, number of shares held by Apple, basically Apple Berhad acquired 80% of Orange. So since the question, they didn't really mention about any changes in share capital when I look at it, okay? So they didn't mention about any changes in share capital. So I just need to take in the equity shares. So this is 25 million and this is 20 million, okay? So number of shares held by Apple, basically it is equivalent to 80% of 25 million. So we get 20 million. And as for banana, since it is 100%, so it's 20 million. Number of shares held by non-controlling interest, it will be 20% over 25 million, so it is 5 million, and banana we don't have non-controlling interest. Now date of acquisition is 1st April 2018 for Orange. 1st April 2018 for Orange. For Apple, for banana is 1st June 2018. Okay, and you are preparing for 31st December 2020. So basically the acquisition is like 2.5 years ago. Okay, so you can just take in your profit or loss as a whole, which means profit from 1st January 2020 to 31st December 2020, basically it already considered as belonging to Apple Berhad, okay, in a form of fair share. So if for banana, since it's 100% holding, so 100% belongs to Apple. Okay, but for Orange, only 80% belongs to Apple. We have 20% for non-controlling interest. Okay. RM per share at the date of acquisition, question never mentioned, okay? But question has already mentioned to all of us that your fair value of non-controlling interest at the date of acquisition for Orange is 13 million following your first information, okay? So this is a very simple one, okay? So that's why for your step number 2, your non-controlling interest at acquisition is 13 million, okay? So consideration transferred. Let's have a look at the information here. Consideration consisted of 55 million for Orange. So let's take in 55 million for Orange. Okay, and as for banana, it is 30 million. So let's take in 30 million. All right. Okay, so your NCI at acquisition, you have already taken in. Now you need to calculate the fair value of net assets of the subsidiary. So your fair value here, let me just use a long form, okay? Fair value. Okay, so that at least you know what is FV. So my share capital of Orange, since question never mentioned about any changes in share capital, so I just take in accordingly. Okay, and it seems that your equity shares is amounting to 25 million. All right, so 25 million, I own 80%. So it is, it is 25 million. Okay, question is 25 million and 20 million. So we just take in accordingly, minus 25 million. And for banana, we minus 20 million. Okay, and your retained earnings at acquisition, question has also mentioned to you. For the first paragraph, basically it is relating to Orange. At that point of time, at the date of acquisition, retained earnings of Orange is 15 million. Okay, so we take in 15 million first. Okay, and then for banana, question has already mentioned retained earnings of banana is 10 million. So we also take in 10 million. Okay. And is there any fair value adjustment? Let's have a look at the next information. The fair value of Orange Sdn Bhad's other assets, liabilities, and contingent liabilities at the date of acquisition were equal to their carrying amount with the exception of a specialized piece of plant which had a fair value of 10 million in excess of its carrying amount. And this plant had a 10-year remaining useful life at the date of acquisition. Okay, so here we have 10 million. So the exception of a specialized piece of plant which had a fair value of 10 million in excess of its carrying amount. So we have 10 million here. So that's why your fair value adjustment, you have to take in another 10 million. Okay, so your goodwill basically it's amounting to 18 million because bananas consideration 30 million. And after you have minus of share capital and retained earnings at acquisition, basically it's equivalent to 0. So which means Apple Berhad only offer 30 million, which is equivalent to the fair value of net assets of banana in order to acquire the share capital of banana. So there is no goodwill involved. But for orange, there is a goodwill involved. And this is 18 million. Okay, so now we can already start to take in our 18 million adjustment. So 18 million after I have taken in, you will notice that there is an out of balance. Why is there an out of balance? Because of all the adjustments that you have already taken in. Now you can actually reverse all of them out. So how you reverse all of them out? Okay, so this is actually a double entry. Yeah? So after I have taken out my 18 million, what are the items in my goodwill? The first item is consideration transferred. Total is 85 million. And my investment in subsidiaries also 85 million. So I will have to minus it off. Okay, minus of 85 million. And then I have my NCI at acquisition of 13 million. So NCI at acquisition basically is 13 million here. Okay, additional, you have to take in because it's considered as like a liability to you. All right, for assets part is a liability part, so you just minus off. But we don't call it as a liability part. Somehow or rather, we call it as not off. Okay, offset, because this is a consolidation. So we reflect goodwill, we offset investment in subsidiaries. Okay, that's how we term it. So I have a non-controlling interest of 13 million. So I still have 18 million to go. So let's see here. My share capital basically totaling to 45 million. And I have already mentioned that for ordinary shares, we have to take out the subsidiaries portion. So you can either just follow your goodwill or you can just use formula. Okay, so at the end of the day, your ordinary shares in your consolidation must only reflect the parent's portion. Okay, it must only reflect the parent's portion. Now, we are left with 35 million because of your retained earnings at acquisition and fair value adjustment. So my fair value adjustment is 10 million and it's on a specialized piece of plant. So which means it increases the property, plant and equipment value. So I have to take in additional 10 million. Okay, and then I am left with 25 million because of my retained earnings at acquisition of 25 million. So I just need to minus off from my retained earnings because this 25 million, it doesn't belong to the consolidation. It doesn't belong to Apple because these are all pre-acquisition retained earnings. So it doesn't belong to them. So that's why you have to take out. So now your adjustments are already tally. Okay, your adjustments are already tally. That is how you complete your step 2. Okay, is everyone following me? Can you raise hand if you are following me? Follow, yeah? Anybody thinks that I'm too fast? Yes?
Miss, I got a question. In the exam, can we use the short form for the description for the like equity liability?
No.
Cannot.
Cannot.
All must comply IAS 2, is it?
IAS 1. Yes. Yes.
Okay.
All right. Remember that you must when you prepare consolidated financial statement, it has to be in accordance with IAS 1 as well. All right. If you did not comply, then very sorry. Marks will be penalized. Okay.
Miss.
Yes.
Can slow down a bit. Too fast.
Okay. No problem.
Yeah, thank you, Miss.
Okay. So, do you need me to repeat?
Miss, can you just show us back the consolidation statement just to recheck?
Consolidation statement?
This entire thing that you're showing right now.
This one?
Yep. Just want to recheck and see if we keyed in everything.
Okay. Okay, so do you need me to repeat again? Can you raise your hand if you think you want me to repeat? No raise of hand. Raise of hand. Okay, so I will repeat. Okay. Okay, so again, so for goodwill, I think all of you have no problem in calculating already. Okay, because for consideration transferred, question is very straightforward. Question only gave you cash consideration, cash consideration, which is immediate consideration. And this 55 million plus 30 million is equivalent to 85 million, and it's already reflected here. Okay, so as you can see, this is not a really good financial position because it is not in accordance with IAS 1 presentation of financial statements. We are mentioning all the informations in the statement of financial position, not in a single line item and follow up with notes. Okay, but in your exam, it is advisable that you prepare based on IAS 1, or I can say it's mandatory preparation. So here is 85 million, right? Okay, so your total consideration is 85 million. So now the first thing I have to minus off my 85 million because I am using it to calculate my goodwill. All right. And then we have NCI at acquisition. So your NCI at acquisition of 13 million, this is actually belonging to your non-controlling interest because that is the consideration that your non-controlling interests have provided. Okay, they pay 13 million in order to acquire 20%, right? 20% of shares of Orange. Okay, and then we move on to fair value of net assets of subsidiary. Now, as I have mentioned to all of you, for share capital part, you also have to offset between Orange and Banana, between your subsidiaries, and to only reflect the share capital of parent. Why? Because your fair value or your share capital for subsidiaries has already been taken in to calculate goodwill. So that's why you have to take out. Okay, so your share capital of 45 million, all right, you can just minus it off. Okay, and then you have your retained earnings at acquisition. Now your retained earnings at acquisition, these are basically a pre-acquisition RE, and you know that basically parent they are not entitled to pre-acquisition RE. Anything that related to past before the acquisition date, okay, parent company, they are not entitled. So that's why you have to minus it off from your retained earnings as well. So this is how much already? Yeah, the 25 million. Okay, so I minus off 25 million. Okay, and then I have a fair value adjustment. And this fair value adjustment is due to a specialized piece of plant. So which means there is a revaluation increase. Okay, considered as a revaluation increase. It has increased the value of the property, plant, and equipment. So that's why you have to take in additionally. Okay. And the last one is to calculate your goodwill. So you know that your goodwill is 18 million and my balance is also 18 million. So I will take in my goodwill of 18 million. All right. Now my consolidation adjustment for my assets part is 57 million. My liability part also 57 million. So tally for my first step. All right. Tally for the first step. Okay. Is everyone following me? Is everyone following me? Can raise your hand if you are following me. Okay, follow. All right. So I just show you the assets part. All right. So this is the first adjustment that we have already made. Okay, 10 million, 85 million, and 18 million. All right. That is for your non-current assets portion. And then for your equity part, you have taken out the ordinary shares of the subsidiary. You have taken out the pre-acquisition retained earnings, okay? Because ordinary shares, you must do offsetting. So that's why. But the main reason is because you have taken in to calculate your goodwill. All right? So if you didn't take out, then it seems like double taken up issue. It is because of the transaction, the the debit and credit impact. That's why you have to take out only. All right. And your retained earnings, this basically belongs to orange and banana respectively. So that's why Apple Berhad is not entitled to earn this 25 million. So it was taken out from the equity part. All right. So that's it for your goodwill. Okay. So let's move on. On 1st December 2020, Orange Sdn Berhad sold goods to Apple, subsidiary selling to parent for 6.4 million. Okay, so this is during the year because we are calculating for 31st December 2020. So since it is during the year, so we don't read the rest first. Okay, we just focus on this 6.4 million first. Now, subsidiary selling to Apple. This is considered as a intra-group sales. So intra-group sales, what we do? Intra-group sales and purchases, we will eliminate off. So let's do the first elimination. All right, this elimination will have an impact on your revenue and cost of sales. So I minus 6.4 and I plus 6.4. Okay, so as you can see, this is what we meant by elimination. So your console adjustment will become 0. Okay, that is what we meant by elimination. All right, there is no impact on your retained earnings. Okay, it is just a console adjustment impact. All right, and then now we can move on to calculate unrealized profit, if any. So question has already mentioned to you that this is a margin. So margin is divided by 100. Okay, divided by 100. And question mentioned that Apple Berhad still held all of these goods in its inventories as at 31st December 2020. So still held everything. Okay, so since you still held everything, then you will have to calculate the unrealized profit for 100%. So step 3, note 2, Orange subsidiary sold goods to Apple parent, and this shall be adjusted from Orange retained earnings because Orange is the one earning the profit. Okay, Orange is the one earning the profit. So that's why it has to be adjusted from the retained earnings of Orange. And how do you calculate the unrealized profit? Basically, the sale is amounting to 6.4 million. And question has already mentioned to you that it is 15% on margin. And question also mentioned that all of the inventories were still held by Apple. So now we have 960,000 of unrealized profit. Okay, so this 960,000 of unrealized profit, we will have to minus off from your cost of sales as well. Okay, minus cost of sales 960, and then you have inventories, you also have to minus off 960. Okay, so there is definitely an out of balance of 960, and this out of balance, it's because of the retained earnings portion that you have to adjust together with non-controlling interest. Why you have to adjust these two portions? The main reason is because 960 was earned by whom? Earned by Orange, earned by the subsidiary. So any profit earned by subsidiary, Apple will only get a fair share of 80%, and 20% will be absorbed by non-controlling interest. So this 960, if you want to, you can adjust straight. You just minus 960 times 0.8. Okay. And then for your non-controlling interest part, minus 960 times 0.2. And then that's it. You will tally already. Okay, and later on, of course, we have to do a cross-checking whereby you are also required to calculate your group retained earnings. Now, I have already prepared the group retained earnings on step 8 for your group retained earnings here. If you want to, you can take in now. If you don't want to, you can take in later. Okay, and then this step 8 basically serves as a checking to ensure that you already get the answers correctly. All right. So I don't want to do first, okay? So I will just guide you on the double entries now. All right, so are you following me for this step? Step 2, step 2, step 3, step 3, note 2. Are you following me? Can raise your hand if you can follow up until this stage. No raise hand, so which means cannot follow. Can raise hand if cannot follow. So everyone raise hand cannot follow. Okay. Too fast. Okay. So again, I will take out the 960 adjustment first. Okay. I will take this out first. Again, 6.4 million can follow? 6.4 million? Raise your hand if you can follow the 6.4 million. That one was for your intra-group sales transaction. Okay, that part should be able to follow. Okay, so now we will have to calculate our unrealized profit. So for step number 3, question has already mentioned to you this is a gross margin of 15%. So margin of 15%, you know that it is over 100. Okay, over 100. And the question has already mentioned Orange sold 6.4 million goods, okay, to Apple. So 6.4 million is basically the selling price. So now I want to calculate the unrealized profit. Okay, unrealized profit means that the profit earned by Orange, but then it has not been realized because Apple has not sold. Okay, that is what we meant by unrealized profit. So now you have already calculated the unrealized profit, which is 960,000. So this 960,000, you will have to minus off from your cost of sales because it actually reduces your closing inventories. So minus 960, okay, reduces your closing inventories. All right, minus already, minus from cost of sales. And then on your inventories part, you also have to minus 960 because as I have already mentioned to all of you, it actually reduces your closing inventories. Okay, for this part, can follow? Can raise your hand if you can follow? Can follow, this part can follow, all right? Then after that, you will be able to see an adjustment of 960,000. Now, again and again, I want to remind all of you, retained earnings comes from the profit. So in the past, we don't call it as retained earnings. In the past, we call it as accumulated profit. Okay, that is what we term it in the past. All right, but now we want to be glamour, so we call it as a retained earnings. Okay, in the past, it is accumulated profit. What does it mean by accumulated profit? Accumulated profit means that a profit that you earn since day one will be accumulated in your statement of financial position. Okay, so which means any adjustments made on your statement of profit or loss, it will have an impact on your retained earnings because your statement of profit or loss at the end of the year, all right, it will flow to your retained earnings. That's why statement of profit or loss every year, it will be a fresh beginning. Okay, which means the following year, there will not be any balance carry forward. All right, so which means it's a fresh year and you will be able to calculate the profit that you earn for 12 months, which means for 1 year. All right, because every single year's profit will be carry forward or will be transferred to retained earnings. All right, so that's why when you have an adjustment on your cost of sales here, your 960,000 on your consolidated statement of profit or loss, any adjustment here will have an impact in your retained earnings. Okay, so that's why I am taking it out. All right, I have to take out from my retained earnings. But then when you look at the question here, I have specifically mentioned about this. Orange is the one earning the profit. So it has to be adjusted from orange retained earnings. When it has to be adjusted from orange retained earnings, what will happen? The profit of orange will reduce, correct or not? Because you have already adjusted from here. You have already minus off 960,000, which means you have increased your cost of sales. All right, you have reduced your closing inventories, you have increased your cost of sales, bringing down your profit. Okay, so when it was adjusted from the orange portion, you must remember Orange is a subsidiary of Apple, but basically Apple only owns 80% of Orange. Hence, this 960,000, right? Okay, Apple's portion on Orange unrealized profit, yeah, for this transaction. Let me just use this so that at least you know what does it mean by UP, yeah, okay. Okay, Apple's portion on Orange unrealized profit, basically it's only 80% times 960,000, okay. And non-controlling interest portion on Orange unrealized profit, it will be 20% times RM 960,000. Okay, so now 80% of 960,000, you will get 768,000. Okay, NCI's portion times 20%, you will get 192,000. All right, so that's why when you reduce, since this is a reduction in your statement of profit or loss, you already know that it will also reduce your retained earnings and reduce your non-controlling interest because the profit portion has already been reduced. Okay, so that's why for your retained earnings, you can take in 0.8 minus 0.8, yeah, times 960, okay, and for your non-controlling interest also minus 0.2 over 960, okay, which means the reduction of profit has already been shared between Apple and the non-controlling interest of Orange. Okay, understand so far? Understand so far? Can raise your hand if you can follow at this point. Can follow, all right, can follow, yeah, okay, then I will move on already. The next one is basically the same thing, but the only difference is parent is the one selling to subsidiary. So if you look at my step number 4, okay, step number 4, parent sold goods to Banana, which is the subsidiary. So this will be adjusted from the parent's retained earnings because parent earns the profit. Okay, so since it was adjusted from the parent's retained earnings, simply means that there is no profit sharing. Apple will have to reduce this profit on their own from their account. Okay, no need to share with anybody. All right, so Apple sold goods earning a markup of 25%. Okay, and the first thing that interests me is on the 8 million, and this is also during the year. So since it is during the year, this 8 million, you also have to eliminate off from consolidation. So here, same thing, okay, your revenue part minus 8 million, your cost of sales part, you plus 8 million. Okay, so that is console elimination. So as you can see here, in my statement of profit or loss, currently it is still reflecting 960,000 adjustment, which is the one and only adjustment relating to unrealized profit earned by Orange. Okay, so any intra-group sales and purchases will just be eliminated like that. All right, for this, can follow, 8 million can follow? Can raise your hand if can follow? Okay, can follow, then I will move on. So this is a markup of 25%, okay? And Banana still held 30% of these goods in its inventories at year end. Okay, so 30%, markup 25%. All right, so let's do the calculation here. So your unrealized profit question has already mentioned to you. Apple sold 8 million of goods to banana. This is the selling price, okay? And this is a markup of 25%. So markup means 25 over 100 plus profit portion. So 25 over 125. Margin is 15 times 15 divided by 100. So which is your cost plus profit equals to 100. Markup 100 plus profit. Okay, so that is your markup. All right, and question also mentioned only 30% left unsold. Okay, so we only factor in 30%. 8 million times 25 divided by 125 times 30%, you will get RM 480,000. Okay, so this 480,000 is an unrealized profit that has currently been in banana's book. Okay, been in banana's inventories because the inventory has already been transferred to banana, and to banana they will treat this as a cost. Okay, this 480,000 basically it's a cost to banana because banana purchased from Apple. All right, so this 480,000, it will also have an impact whereby it will reduce your closing inventories, increasing your cost of sale further. Okay, so 480,000 increase cost of sale further. So your cost of sales is even more expensive considered as that. And your inventories, all right, your closing inventories will be reduced by 480,000. Okay, so this point you must be able to grasp by now, yeah. Okay, so everyone, can you follow up until 480,000 part? Can raise your hand if you know how to take in 480,000. Okay, you know how to take in already, yeah? All right. Then now again we have an adjustment of 480,000. So this 480,000, you want to know whether you want to adjust from retained earnings or non-controlling interest or a share. So now, what does the question tells you again? Apple sold goods to banana. Parent is the one selling to subsidiary. So this shall be adjusted from your parent's retained earnings because parent is the one earning the profit. So there is no profit sharing here. Okay, so that's why this 480,000 you can straight away minus off from your retained earnings. All right, you don't have to do anything already because there is no profit sharing element here. All right. Okay, can raise your hand if this adjustment is okay. Okay, yeah. All right, then I will move on already. Now we have the next adjustment. So this next adjustment, basically it is quite similar to your unrealized profit. The only difference is that this is a piece of non-current asset. So on 1st Jan 2020, Orange Sdn Bhd sold a piece of machinery costing 1 million to Apple at 1.5 million. Apple Berhad had taken up 10% depreciation charge on the machine, okay, of 150,000. So 10% times 1.5 million, that's how you get 150,000. So if you look at my step 5 here, Orange sell machine to Apple at 1 million. So profit on disposal basically will be taken up in Orange book. Okay, so increase Orange profit because this is a profit on disposal, right? So increase Orange profit. And how much is the profit on disposal? The question has mentioned selling for 1.5 million, but the net book value or carrying amount of the asset is only 1 million. Okay, so this is a 500,000. Orange sell machine at 1.5 million. All right, so the profit on disposal is taken up in Orange book. It increases Orange profit. So you already know that since it increases Orange profit, for for selling of non-current assets, we will also perform elimination. Okay, elimination will be performed in order to return to the original carrying amount of NCA, non-current assets, and depreciate following all depreciation. All right, that was the whole reason why we have elimination, because elimination will be performed in order to return to the original carrying amount. So I want to return it to 1 million carrying amount, and I depreciate following all depreciation. So if it's 10% on this 10% of this 1 million, then it will be 10% of 1 million. All right, so the question here, they mentioned about 10%. Apple Berhad had taken up 10% depreciation, so I just take in according to 10%. Okay, because most of the time subsidiary, as I have mentioned to all of you, accounting policies, subsidiary must follow Apple. So what is Apple's policy? That subsidiary must follow accordingly. So since this is a subsidiary selling to parent's policy to take in 10% depreciation, subsidiary is also following the same basically. Okay, so I am returning the depreciation following the old method. Okay, old depreciation and old carrying amount. Okay, so my profit on disposal here, since taken up in orange book, increases orange profit by 500,000, we have to take out the 500,000. Profit on disposal will be taken out from your other income of 500,000. Okay, and then your property, plant and equipment. Okay, the carrying amount has already increased by 500,000 because of the profit on disposal impact. Okay, because your carrying amount is now 1.5 million according to Apple. So I want to take out 500,000 in order to reflect this 1 million only. All right, in order to reflect 1 million only. So that's why my non-current assets here, I will take out the 500,000 so that it returns the machine value to 1 million rather than 1.5 million. Okay, so that was your double entry. And since it actually affected the other income, you have already reduced the profit of orange. Okay, reduce the profit of orange. You already know that Orange basically is a subsidiary or partially owned subsidiary of Apple. So this 500,000 will be shared among retained earnings and non-controlling interest. Okay, so that's why we have this 500,000. So your retained earnings here, again, because it's a reduction of profit, so you just minus 500,000 times 0.8 because we are sharing with non-controlling interest. And then non-controlling interest portion will also be 500 times 0.2. All right, so now it is actually tally again. Okay, so always remember when there is an adjustment relating to the subsidiary, depending on the shareholding, okay, then you have to adjust your retained earnings and non-controlling interest part accordingly. Why? Because later on, your non-controlling interest at year end, you have to calculate the share of profit portion. All right, share of profit portion. Okay, so that's why you have to apportion out accordingly. All right, for this part, 500,000 profit on disposal can follow. If can follow, can raise your hand if can follow. Okay, can follow. Anybody wants me to repeat this part? Raise your hand if you want me to repeat. No raise hand, Okay, so no need to repeat. Good. All right. Then now we have already completed the profit on disposal issue. We need to tackle the excess depreciation part. Okay, so as I have mentioned to you just now, your excess depreciation basically it's on the profit on disposal. All right, that is your excess depreciation. All right, question has already mentioned that the depreciation charge is 150,000. If following the actual carrying amount of 1 million, 10% of 1 million is 100,000. But Apple Berhad has taken up a depreciation of 150,000. So there is an additional depreciation taken up of 50,000. That's how we know that it is an excess depreciation. You can also take in 1.5 million minus RM 1 million, okay, and then times 10% of depreciation. That's how you derive to 50,000. And this 50,000 will be taken up from Apple's book. Okay, Apple's book, reducing Apple's profit. Okay, because this is a depreciation, so it will reduce Apple's profit. So now this excess depreciation, we also have to reverse out, so that I will return the depreciation value following 1 million rather than 1.5 million. Okay, so this excess depreciation of 50,000, we have to reduce out. And this 50,000, okay, since this is a machine, so it's a machine, so I will classify this depreciation under cost of sales because this is a machine. Okay, usually machine we will use for ordinary courses of business. Okay, so it's for business purposes, for operation purposes. So most of the time for machine, I will classify it under cost of sales. I will reduce under cost of sales. So your excess depreciation means that you want to reverse out, you have increased your profit. I have increased my profit, reducing my cost of sales. So that's why I add 50. Okay, because your cost of sales, as you can see here, all are negative. Okay, so when you want to increase your profit further, then you just add 50,000. Okay, so it reduces your cost of sales already. Then it increases your profit. And this 50,000 will also have to be adjusted from my property, plant and equipment. So my property, plant and equipment, I have already taken this depreciation, so it reduces my value. So now I have to add another 50 to increase my value. Okay, so basically it is all about double entries only. Okay, so this 50,000, it is considered as an increase in value because you have reversed out the depreciation. So the value of your asset has already increased. Okay, that's for your 50,000. All right, can follow for this 50,000 on excess depreciation? Can raise your hand if you can follow. Okay, thank you. So if can follow, then you know that again and again there is an adjustment here of 50,000. Okay, and just now we have mentioned that basically excess depreciation taken up from Apple's book, it reduces Apple's profit because depreciation is an expenses. Now I want to reverse it out, so it increases Apple's profit because you have reversed out an expense. So since this was taken up in Apple's book, this is a parent, so there is no profit sharing. So this 50,000 you can just straight away adjust from your retained earnings. Okay, so you add 50. Okay, so as you can see here, it is 0 again. So you add 50. All right, add 50, yeah, because your Apple's profit has already increased. So it increases your retained earnings. Always remember, when you get confused, you always remember that retained earnings comes from profit. If profit increase, retained earnings is a plus. If profit decrease, retained earnings is a minus. All right, that is how you just need to remember the sequence only. Okay, basically it is quite simple. All right, so that one is for your 50,000 of adjustment. Now we will move on to the next one. The next one talks about dispute. So there is a dispute reported on the receivables of Apple. One of the finance manager had accidentally taken up a sale transaction amounting to 500,000 which belongs to other entity. So this is not a revenue by Apple Berhad. This is not Apple Berhad's revenue. Okay, so since it is not Apple Berhad's revenue, currently you have debit trade receivables and credit sales. So we have to reverse out debit sales and credit trade receivables. And the amount is 500,000. So for this, it should be very simple for all of you. Okay, so I am reversing out my sales of 500,000. Okay, reverse out my sales of 500,000. And my trade receivables, I also have to reverse out because this transaction doesn't belong to Apple. Okay, and again, you know that there is an out of balance of 500,000. And since this is all related to Apple, you just need to amend on the retained earnings. And it is a minus 500,000. Main reason is because this is a profit reduction. All right, when there is a decrease in profit, you minus retained earnings. When there is an increase in profit, you plus retained earnings. So again, it is tally already. All right, this should be very simple. The next one, in trade receivables of Orange, it is reported that Apple Berhad is still owing 1 million. Okay, so that's why you can see here, I have all this yellow and blue box. Okay, so which means the transaction is 1 million. So assuming it's 1 million, and who is owing who? Apple owe 1 million. Okay, so for 1 million, you know that Apple owe 1 million. So this is debit purchases, credit payables. Okay, and Orange, debit trade receivables and credit sales. That is 1 million. All right, and Apple claims that they have already made a payment. They have already made a payment of 500,000. So this 500,000, Apple has already made payment minus 500 and trade payables plus 500. Okay, so basically trade payables outstanding. Let me just classify here as TP. TP, and this is TR. Okay, and I add another one row. So this is a TR or TP outstanding. TR or TP outstanding. All right, so for trade payables, recorded in Apple book, basically they still owe Orange 500,000. But recorded in Orange book, they still owe Apple still owe them 1 million. The main reason is because Orange deemed that they have not received this 500,000. The question has already mentioned 500,000 they have already transferred on 31st December. Maybe this is in the form of check. Okay, we're not sure. So that's why Orange have not taken up. But this, since this is a related party transactions and there is a physical proof that Apple has already transferred 500,000 to Orange. So Orange will have to take in as receiving the 500,000 already. Okay, and these are the double entries that Orange has yet to be made. Okay, your debit bank and credit 500,000. So we will have to take in this transaction first. Debit bank and credit 500,000. Okay, so we have to take in this first, assuming that Orange has already received the money from Apple. Okay, so after you have taken in this transaction, the next one we will also do elimination, which is trade receivables and trade payables elimination. So now, reflected in Orange book, okay, Apple still owe Orange 500,000. Reflected in Apple's book, Apple still owe Orange 500,000. So basically, this two part is already tally. And as you can see here, the sum is amounting to 0. So we have to do elimination accordingly. To Apple, it is a trade payables. So which means increasing trade payables. So now we have to minus off the trade payables, minus 500 and trade receivables also will be reduced by 500. Okay, that is for your elimination of trade receivables and trade payables. Because in both books, they deem that they still owe each other 500,000. Apple owe Orange 500,000. Apple owe Orange 500,000. In Orange book, Apple still owe Orange 500,000 also. Okay, so according to consolidation, you have to eliminate off. So that's why your payables and accrued transaction, you will have to reduce your payables, eliminating off the 500,000, and reduce your trade receivables, eliminating off this 500,000 as well. Okay, for this part, everyone can relate, can follow. Can you raise your hand if you can follow this part? Only Divya. What about the rest? Can follow? Are you still with me? Okay, so you're still with me, can follow, okay? So since you can follow, then I will move on already. So now we have reached to the last part. There is no impairment in goodwill. Okay, so now we have completed all the steps. All right, now we can already calculate our